I've gotten a ton of requests from you guys asking me what stocks I think are pretty much on sale right now and offering some incredible value in the market. These times that we're seeing are unprecedented. We haven't seen this much volatility in a very long time before. But with volatility comes opportunity, and now is the time to start looking for some great dividend stocks for your portfolio. So what I've done for you guys is put together a list of 10 great dividend stocks that are down 30% or more that I think will be absolutely fine over the long term. So if you appreciate this video, all you have to do is just hit that like button down below and help us get 500 likes on this video. Truly appreciate that. And I also want you guys to comment down in the comment section below letting me know what dividend stock you are personally buying during these volatile times. So what I'm going to do for this video is I'm going to break down this list into pairs, and each pair is going to be from a different sector. So I hope you guys enjoy this kind of different style that we're doing here, and if you do, I can do this for future videos as well. So let's start off with the restaurant space with some food related stocks. First up, we have McDonald's, which is down a whopping 32% so far. Now, the reason McDonald's is down is because they have been closing their dine-in for their restaurants, and there's fears going around because of this that they are going to see a big slowdown in the number of orders that they receive. The benefits of McDonald's, however, is that they are a worldwide company, so they have exposure outside of the US as well. They are a strong blue chip company, and they're actually one of my favorite companies in all of the stock market. McDonald's currently offers a 3.36% starting yield with 43 years of dividend growth and a low payout ratio under 59%. The second stock from this sector that I want to discuss is Starbucks, which is down over 37% so far. Similar to McDonald's, the fears here are around slowdown in orders because all they're accepting now is takeouts and orders that are to go because they want to reduce the chances of anyone getting sick. And because of this, the stock has really taken a huge hit as investors know that this is probably going to reduce the number of sales that they have. Now, similar to McDonald's, they also have worldwide exposure, but the good thing here is that they are open back in China again, so they are going to see some revenue come in from there as well. Starbucks is also a very strong brand with a lot of growth ahead of it, and I think that over the long term, Starbucks may actually outperform McDonald's here. Starbucks actually offers a 2.8% starting yield. They grow their dividend by a whopping 22% on average year over year, and they have a payout ratio under 58%, which is very sustainable. The next sector that I want to look at is the consumer related sector, which has been hit incredibly hard because most people aren't really out there shopping and enjoying themselves right now. First up, we have Nike down 33%, and this is again because they've closed their stores in the US, Canada, Australia, and Western Europe, so pretty much most of the developed nations are closed. The other big thing that's going against Nike right now is that sports around the world has been halted, so it's less advertising exposure for them. On the plus side, however, online sales still remain open for Nike, and they are open in China right now in store, so they should see some revenue come in from there. Nike offers a fairly small 1.47% starting yield dividend, but they have been growing their dividend by over 12% for 16 years straight, with a payout ratio under 35%, which is very good. The second stock in this sector is Disney, down 37%, and this company is getting hit very hard during these times. Their parks are closed, their stores are closed, their movies are delayed because theaters are closed, but luckily for them, they did launch Disney Plus recently, and they should see some uptick in subscribers from this. Worldwide, this company is respected, and it is a brand that's going to be around for a very long time, in my opinion. Disney offers a 1.85% starting yield with 10 years of growth while maintaining a payout ratio of around 34%. So there's lots of room to grow this dividend over the long term. Next, I want to discuss some tech-related stocks, but these are a bit difficult because most tech companies don't really pay out a dividend. They're all focused on growth, and investors like that about them. However, after digging deep, I did find two older tech companies that offer a pretty good dividend right now. First, we have IBM down 32%. Now with IBM, it's interesting because I don't really see a lot of negative directly affecting IBM right now. Of course, they may see a slowdown in the number of orders that they receive for certain parts of their business, but that's going to be expected with pretty much any company out there with the economy taking a massive hit. Now on the plus side, I see the stock really has moved down with the general market, so it's not really of IBM's fault particularly. The demand for their cloud probably has spiked during these times as companies choose to work from home. And I think this will just result in IBM having one of the best recoveries out of all tech stocks. Now, IBM offers a huge 6.54% starting yield with 20 years of growth while maintaining a payout ratio under 49%. And really what I get from this stock is that they want to be a long-time dividend payer. And with a payout ratio this low, I think they're well on their path to doing that. The second tech company is Cisco, down 32%. And this industry as a whole was slowing down as per their guidance for 2020 before any of this hit. Now on the plus side, we should see a pretty big spike in Cisco because orders for their WebEx should pick up during this work from home time. When customers need to work from home, they're going to rely on video conferencing, audio conferencing, all that kind of stuff, and Cisco offers those services. Now Cisco boasts a 4.27% starting yield with a growth rate of over 13% year over year, all while maintaining a payout ratio under 45%, leaving lots of room to grow this dividend as well. Now moving on, the next sector is the industrial sector, and these stocks typically have a very cyclical nature to them, and right now they're on the lower part of that cycle, so they're showing some extreme value here. First, we have Leggett & Platt down 45%. Now, like I said, this is a cyclical stock and it does hurt when the economy hurts. They also may continue hurting until we exit the recession, so there may be much more pain ahead for this company. Now, on the plus side, they're almost a dividend king, and they are a small but very stable business that has been around for a very long time. Leggett & Platt sports a 5.83% starting yield with 47 years of consistent growth, almost at king status like I just mentioned, and their payout ratio is about 64%, which is manageable. Next up, we have Caterpillar, down 33%, another cyclical stock, and this stock really has been beaten up ever since the US-China tension started back in 2018. Now, this is one of the only companies that makes construction equipment, and they are a strong brand and business worldwide. So as the global economy starts to pick up, whenever that is, Caterpillar should be one of the biggest beneficiaries from that. They offer currently a 4.41% dividend yield with 26 years of growth, making it an aristocrat, and it maintains a payout ratio of under 46%, making this dividend safe. Now, the last two companies that we're going to cover come from the financial sector, and I tried to pick two companies that were kind of different in that sense. One is kind of a credit card related company, and one is a traditional bank. First up, we have American Express, down 36%. And there's a lot of risk with this business along with their credit card business because they do lend out to other businesses and they could see a lot of defaults on this. American Express is actually really big for travelers with their credit card, but currently none of this is happening as travel is pretty much grinded to a halt worldwide. Now they are right behind Visa and MasterCard in the credit card department, so there's still lots of room to grow here as they capture market share over time and expand globally. American Express offers a 2% starting yield, which isn't too big, but their payout ratio is under 20%, showing that this company can grow much quicker over time. In the short term, we may not see this grow that rapidly with all the financial issues that the economy is seeing, but over the long term, I think that this will be a good dividend stock. At number 10, we have JP Morgan Chase with a 33% decline. This company has more risk with interest rates dropping to 0%. They could face challenging times during this recession if we go through one, as many industries will require help from them on their debt payments. But on the plus side, they are the largest bank in America, and they did get through the financial crisis in 2008, and I don't think that this crisis that we're going through right now will be nearly as bad for banks this time around. JP Morgan offers over a 4% starting yield at 4.07%, and their growth rate year over year is over 16%. And you combine this with a low payout ratio of under 34%, and this leaves us with a company with a lot more room to grow in this department. So that kind of rounds off my list here of 10 dividend stocks that I think are incredible companies that are down over 30% currently. But you may have noticed that there are a couple sectors that I chose not to include in this video. One is, of course, the healthcare sector, and the reason I didn't include them is because a lot of these stocks are actually holding up pretty well right now as the world waits for some sort of vaccine news. And there's a lot of hope that one of these large companies will come out with that sooner or later. But if you are interested in a healthcare stock, one to look into maybe Pfizer right now. The other sector was oil that I didn't really discuss, and I want to really save that for another video because there's a lot to discuss there when it comes to oil with the recent 30% drop in prices. But I'm not really sure if you guys want to hear about that, so I'm going to keep that out of this video. If you do want to hear about it, let me know in the comment section down below, and I can create a separate video just discussing the whole oil issue that's going on right now and some companies that may be good values in that sector. Also, don't forget to let me know what dividend stock you are buying right now in the comment section down below. I'd be really interested to hear, and I'm sure the rest of the community would want to hear as well. Guys, thank you so much for watching. Hope this video was valuable to you. But either way, don't forget to drop a like, don't forget to subscribe, and I'll see you in the next one. Peace.